Silver's nominal high was $50, but the inflation-adjusted number is more like 80. So silver, I think, has a while to rip. In my own experience, as we talked about earlier, uh, precious metals bull markets are inevitably led by gold because the first buyer is a fear buyer. When the gold, pardon me, when the precious metals narrative gets established by gold and the momentum comes into gold, the next step is the generalist investor coming down into the precious metals space. And the generalist investor, whose motivations are both fear and greed, tends to favor silver because of its volatility and perhaps because of its lower unit price over gold. And then leadership changes to silver. And in my experience, when that happens, you don't have to look for some subtle signs. The upward price pressure on silver is so dramatic that nobody needs to tell you that silver is broken out. There are people now who will argue that a breakout in the silver price above 31 or 32 to 35 is something special. Judging from past silver bull markets, that's a rounding error. I mean, truly a rounding error. So I'm not convinced that the silver bullion is in a breakout phase or that leadership in the precious metals bull markets is going to shift from gold to silver. I remember in our earlier interview describing the high-quality junior stocks as a coiled spring. That wasn't so much about the fact that I thought the silver price was going to break out. It was about the fact that the silver equities were hated. They were hated, I think, because a whole generation of speculators was spawned in 2010, 2011 with the Reddit silver squeeze. They had expected immediate gratification. And when they didn't get it, let's just say that there's no hate as sincere as the hate of a jilted lover. And the junior silver stocks probably ran into 150,000 jilted lovers. Really, truly profound hate. And it seemed to me at that point in time that with or without the silver moving, that there was nobody left to sell. Everybody who wanted to sell, November, December, January, had sold. And that turned out to be, miraculously, even in terms of timing, exactly right. The higher quality junior silver stocks, I think we're going to talk about a couple of them today, are uniformly up 200% without the silver price moving that much. They're up on what I would describe as a dead cat bounce. They're also up on results, which is very, very, very healthy. It is arguable that those stocks don't need to go up anymore at these silver prices. But if past is prologue, and we have a silver bull market coming up, which is to say that the primary metal itself does what it has done, I think people will be surprised at the performance, the ultimate performance of silver equities. Notice that I preceded all of that with the word if. Speculators are looking for certainty, which I think is too much to ask for in any speculative market. You assign probabilities to outcome and you risk those probabilities. And that's maybe what we'll talk about today. The anatomy of a 10-bagger, what's required to get 1,000% in a stock, is, among other things, 5 years or 6 years. Many people that invest in resources have a long-term thesis, a long-term strategy, but they employ short-term tactics. And that's not going to work here. If you're hoping for a 3-month hit, I don't know, go to Las Vegas or, do something fun with your money.
I would like to know your opinion of Dolly Varden.
Well, I need to say that I also own Dolly Varden. I need to say further, the stock has performed very well. It's performed so well that I sold enough that I have my initial capital back. I'm at what I laughingly call the point of no concern, where the stock that I have remaining is, in casino parlance, on the house's money. And I'm very happy about that. I share your high regard for Sean. He's a very, very bright guy. Mm-hmm. He is conversant and thoughtful on a lot of subjects, not just mining, which says something, I say, overall about both his curiosity and his intellect. As you suggest, he's young and has energy. If I had a caution around Sean, it's that he's doing too many things at once. He's involved in too many companies. He's involved with the Discovery Group, which is a very high-quality Vancouver group that's been responsible for global exploration, global development for a long time. Indirectly, the group itself is backed by Frank Giustra, a long-time Vancouver mine financier and friend of mine for 4 decades. So I like all that. The story around Dolly Varden is a lot simpler. They have a high-grade deposit, which has been known about for a very long time. It was in production in the 70s. It languished for a very long time because it was used for various stock promotions. There were some really good, high-quality hits. A new promoter would get it. They'd twin the old hit, get some big numbers, run the stock up, do a financing, live off the financing, and they never expanded the original deposit. When Sean got it, he got serious. As opposed merely to using the drill bit to ramp the stock, he used the drill bit to expand the deposit. Lo and behold, he did. The second thing he did was he went to Ivan Bebic and he bought a deposit called Homestake Ridge above the old Dolly Varden deposit, theorizing that those two deposits in relatively close proximity to each other had a similar genesis. And if they weren't connected, that at least perhaps they represented a camp as opposed to two distinct deposits. And Sean has done three things really. He has continued to drill out the Dolly Varden, the so-called Valley discovery, while he has continued to drill out Homestake Ridge. But importantly, they've begun to do important work between the two deposits to look at the geology and look at the nature of mineralization, and to the extent that they can, tie the two deposits together. If the two deposits do tie together, both exhibit some polyphase mineralization, which is good. If the two deposits do tie together, and I'm not saying any that they do, by the way, I use the word if those two are related, that has profound implications for size. And I think we're going to find that out in the next 18 months. If they don't tie together, but if there is sufficient mineralization at the ridge and in the valley, and if that mineralization is consistent enough that one processing facility can be utilized for both deposits, that's probably a home run. But if the deposits do tie together in some way, shape, or form, then the tonnage implications are such that it's a long ball home run. What could go wrong? Pretty easy. I could be wrong. If they don't develop enough ore at one or the other deposits, this becomes a science project. That's the nature of exploration. You're answering a series of unanswered questions. Mercifully, with this one, there's 3 potential unanswered questions. And they all have relatively rewarding circumstances if the answers are yes. Thus far, the answers are yes to the Valley Zone, yes to Homestake Ridge, and maybe to the combination of the two.
Why you like Tier 1 assets is almost a rhetorical question, but I'd like to discuss that. Just briefly, how do you look for them?
Let's define Tier 1 assets first.
Yes.
A minimum of $10 billion in recoverable reserves and resources at current commodity prices, with the ability, once in production, to generate at least $1 billion a year in sales revenue, with all-in sustaining costs, not total costs, but all-in sustaining costs in the bottom quartile for its commodity on a global basis, and return on capital employed in the best quartile in its commodity worldwide. Now, my preference is not for $10 billion deposits. My preference is for $30 billion or $40 billion or $50 billion deposits. But you don't always get what you prefer. I've learned in my life, sadly, Andy, and we alluded to it earlier in the interview, that everything that can go wrong with a small mine can go can go wrong with a big mine, but only a big mine can make you big money. And a big mine can survive the mistake because it has the reserve life to come back and make you whole. Very long reserve lives, which you have in big mines, mean that if your commodity price forecast is wrong by a couple of years, you have enough mine life left that you can amortize that 2 or 3 year time mistake over a 25 or 30 year remaining mine life. And finally, 50 years of experience, which is sadly now what I have in this business, teaches me that all deposits yield surprises. And in big deposits, the surprises are almost always good. And in small deposits, the surprises are often bad. Big deposits give you leverage to exploration upside. They give you leverage to commodity price. They give you the scale to lower your operating costs by increasing the capital expense and amortizing it over more years of production. Great big mining companies fight a continual fight against depletion, against the deterioration of their asset by production. To remain in business, they have to buy tier 1 deposits. They have to buy 20-year assets or 30-year assets or 40-year assets. So if you are lucky enough to participate in the discovery of one of these assets or the development of one of these assets, one of two good things happen. You decapitalize the asset over 30 or 40 years with very high dividends, or you get taken over. The market pays you now, or it pays you later.